This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
So let's go to the Postgame chart book. Listeners, you'll find the download link in your Research Roundup email. If you don't have a Research Roundup email, it means you're not yet registered at MacroVoices.com. Just go to the homepage, MacroVoices.com, look for the red button that says Looking for the Downloads, right above Larry's picture on the homepage. Patrick, let's take a look at page 2 where you've got the U.S. dollar index. What are your thoughts? If we did get a breakdown below that 89 level, what do you think the next logical target is? Seems to me like it's not just a little bit lower, it's a lot lower.
Right. I mean, I want to make a couple of bigger observations and then talk about some targets. I mean, one of the interesting things is that a lot of people, when they hear about the idea that the U.S. dollar is going to have some big bear market breakdown, they immediately associate it with the U.S. dollar losing its world reserve currency status, and somehow it's the breaking of the dollar. But, you know, when you go and look at the last, 30, 40 years of charts on the dollar, there have been two occasions where the U.S. dollar lost 40+% of its value in these kind of like half-decade long trends. And we really have been in a very sideways trade range bound market for the last 5 years. And we have not had a big currency move. And it really does ask the question whether one is coming here. And more importantly, if we did have a dollar breakdown, I mean, especially for something like the dollar index, which is trade weighted against predominantly the euro, it by default implies that the euro would strengthen immensely over that period. And the question is, in a period where they have themselves all sorts of issues with debt and things like that, can they sustain a much stronger currency on a relative basis? And one way or another, we are at a pretty critical moment. And this is something that Larry was talking about and yourself. And it is a moment where we're going to find out whether this trade range that's been in place more or less for the last 5 years is finally broken. Obviously, a retest of lows that we saw from 2008 to 2014, which are all around the 80 level on the index, are entirely on the table if we have a breakdown. And this is, I think, one of the bigger macro questions to solve. I think almost all the major commodity bull markets that we have seen in the past often came on the back of a weak dollar cycle. And so a breakdown here of this 90 level would certainly be a tailwind for that commodity bull market story, which we're going to be talking about.
I definitely agree that it would be a major tailwind for the commodity bull market. I just haven't decided if it's going to happen yet.
Well, I think the market will tell us. We don't have to decide for it, right? But anyway,
well, and that was exactly my point before, is I think the market's going to tell us in a big way. And in the case of the dollar index, I think we're going to get that decision from the market relatively soon. I mean, in the next few months.
For sure. And so on page 3, I wanted to just show that crude oil chart. And the crude oil has respected that 50-day moving average very well. I mean, it's interesting. It seems that 50-day moving average has worked well for all, not only commodities, but obviously the stock market and a whole array of different stocks. And what we had was a scenario where we had a very quick dip on the downside of crude oil, and it immediately got bought on dip and worked its way to the upper end of this range. What's particularly interesting about this is that crude oil seems to be poised for that potential breakout, but not very many other commodities are. And it's interesting that that crude oil is such a huge market on a relative basis to the other commodities. This certainly is going to be one of the big questions as to whether or not there's still a little bit more left in this reflation trade. If we see that punch to $70+ on the upside, that will certainly get things buzzing in the markets.
Yeah, notice also, Patrick, the tops all being aligned going back to the March high that we had in crude oil, that actually got up to 67.98 on the front month contract, not on the July contract, because back then, in the beginning of March, at that point, the April contract was the front month. But the July contract never got above that. And we're right back up to pressing the same highs or testing the same resistance level on the contract chart that we were testing back in March. When we get through that level, the way I look at this is, even though it doesn't quite visually look like it on the chart, we've really been consolidating since March, trying to get above that 66.60 level on the current July contract. And I think that when that breakout happens, it probably sets the stage for a pretty significant move up from there. The thing is, I don't know if that move starts next week or not for 2 or 3 more weeks. We'll see what happens.
All right, well, I wanted to just touch on some of the energy stocks themselves. So on page 4, I have the XOP, which is the Oil and Gas Exploration ETF. And I particularly chose this over the XLE, which is very heavily weighted in the majors. And what we have here is a chart that looks actually somewhat similar. It's pressing toward its 52-week highs. And I actually think that that this could break out here in line with oil. But one of the interesting observations I was going to make was we're starting to see divergent price action amongst the basket of energy stocks, particularly a few of those majors like ExxonMobil, which has been in the press, and a number of these other ones that are transforming themselves. And we're starting to see less and less energy companies actually breaking out. And so the breadth is thinning, and I'm trying to figure out whether or not that's significant, the fact that we don't have a very broad base participation on the upside. But certainly in the case of the XOP, I think it looks like it's poised to follow through if oil breaks out.
Patrick, it's noteworthy, too, that the closing print is what's most important, the closing price. And I just want to let our listeners know, I've described earlier in today's podcast in the market wrap, hey, it's not quite the close yet. We're still below 66.60, and that's the critical level. As we're speaking right now, Patrick, we've still got 45 seconds left until the pit close, but the price is shooting up through 66.88 as I speak. In other words, we're getting the closing print above 66.60, and I think that's a signal that maybe a breakout is beginning that's going to take us much higher. We'll let you know next week whether that was right or not. In any event, Patrick, let's move on to page 5, where you've got the Metals and Mining ETF, XME.
Right, and this is a broader basket of mining stocks. It has steel stocks and aluminum stocks like Nucor and Alcoa, and it also has a number of gold miners like Newmont and Royal Gold in the baskets. And so this, after just consolidating for a week, looks like it's ready to go for another attempt at a 52-week high, and it's really working higher. And so these mining stocks really don't seem to want to quit. And it really does feel like the price action continues to be very bullish, and all dips seem to be bought. And it looks like they're going to at least take a stab at making a 52-week high early next week.
Patrick, I agree. I think that both precious metals and other mining, like copper mining, looks pretty darn good here. And sure enough, on page 6, you've got a copper chart. Tell us more.
Yeah, well, this is the Global X Copper Miners ETF, the COPX. And what's interesting here is that we once again are finding that 50-day moving average being tested on pullbacks. And in the typical fashion that we see price action work is that you have 52-week new highs, and then it mean reverts and corrects back toward the average, finds support, and then bullishly breaks out. And here we have that same scenario playing out. It'll be really interesting to see whether this is where a brand new bull advance in copper can begin.
Patrick, you've got the URNM, Uranium ETF, on page 7, which has more than doubled since I bought it when they first advertised on MacroVoices. What's going on here?
Right. And Larry was talking about uranium quite a bit, and I thought it was worth putting up some charts on this. And again, almost all of the cyclical style resource companies and ETFs for them have just remained so very bullish. This uranium ETF made a fresh 52-week high in May. The entire consolidation has been just sideways holding at above all of its previous highs that made in February and March, and once again is attempting to break out higher. I know Larry mentioned companies like Cameco, which continue to press 52-week highs as well, and so the uranium space continues to behave very well. And so with the uranium doing well, what's interesting is we move on to page 8 there, Eric. We have the gold miners ETF, the GDX. And what's interesting is that gold miners were the ones in the doghouse through much of the start of the year. The first quarter of the year, they were just not participating while almost every other resource sector was. And what we've seen is since the start of April, that really clean bullish breakout on the upside. And the gold miners have really joined the party. And it's interesting to see that during the pullback that we've seen in copper and a few of these other areas, gold has just held up like a champion. It'll be really interesting to see whether, when we inevitably get some sort of a market correction, whether it's rapidly bought on dip to show the characteristics that are very typical of something that has begun a new bull cycle.
Now, Patrick, Larry also emphasized the importance of coal mining. Is that why Arch Resources is here on page 9?
Yeah, I just wanted to put some context into where the coal miners were. They were one of the last spaces to start joining the commodity bull market party, right? And when we look at Arch Resources, the ARCH, we can really see that it spent an extended period of time consolidating through almost all of 2020. And just recently, here in the last month, have we broke above all of those previous highs around the $50-$52 range that were there for the last 6 months. And so it really does look like the coal miners are getting a little bit of a breakout, and we'll see whether that leads them to heading back toward their 2019 and early 2020 highs. What I also wanted to show, though, was another coal miner in Peabody, and this is a far more volatile one, symbol BTU on page 10. And what's really interesting is just shows the devastation that the coal miners have been under during the last 2-3 years that saw the stock wipe out from $45 basically down to under $1. And we're really now seeing an extended basing formation establish themselves, and they're just starting to turn up. It'll be really interesting to see whether that view by so many people, including Larry, that these coal miners are turning really starts to gain some traction.
Well, Patrick, it's a really interesting story because the ESG movement has essentially shamed the professional investment community out of investing in coal, even though it's actually a profitable investment. That leaves opportunity for other people. In any event, for our listeners who want an even better deal, you can get Patrick's service, Big Picture Trading, completely free of charge. Well, for the first 14 days anyway, by signing up for a free trial at bigpicturetrading.com. Details on page 11.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.